Today, we're going to talk about the 5 best Fidelity funds to buy and hold forever. Hi, if you're new to the channel, my name is Tay from Financial Tortoise, where we learn to grow our wealth slow and steady. In order to guide our conversation, I'm going to use the 3-fund portfolio strategy to frame the Fidelity funds I'm going to recommend in this video. The 3-fund portfolio is one of the most popular do-it-yourself investment strategies. And as the name implies, it's made up of 3 simple funds. Most often an equities fund, an international fund, and a bond fund. So all the funds I'm going to recommend today will fit into at least one of these slots. The first Fidelity fund you want to buy and hold forever is Fidelity's US Bond Index Fund, FXNAX. It tracks the Bloomberg Barclays US Aggregate Bond Index, which is composed of investment-grade government bonds, corporate bonds, and mortgage-backed securities. It holds approximately 8,400 bonds. The top issuers are the US Treasury or issuers of mortgage-backed securities like Fannie Mae and Freddie Mac. It has an expense ratio of 0.025%, which means if you have $10,000 invested in Fidelity US Bond Index Fund, you're essentially paying $2.50 for Fidelity to manage this fund for you. The fund started in 1990, and since then, its average annual total return has been 5.33%. So what are bonds and why do you need them? In the simplest term, bonds are loans. When you buy bonds, you're essentially loaning money to someone. In this case, to a company or a government agency. And they're a very important addition to a well-constructed investment portfolio because of how different they are from stocks. A good analogy I like to use to frame stocks versus bonds is this. Think of stocks as your core wealth-building engine. Without it, you aren't really going anywhere. And bonds are like your brakes. Without it, you could drive yourself off the road. When you have bonds in your portfolio, it helps to smooth out your investment ride because though they have lower returns, they have less volatility. During times of market crash, where your stock investments can dip by 20 to 30%, your bond investments will hold steady and ensure your ride isn't so rocky. So in order to help you smooth out your investment ride, you want to start adding them to your portfolio as you get closer to your retirement age. And if you're invested in Fidelity, consider Fidelity US Bond Index Fund as your core bond holding in your portfolio. The second Fidelity fund you want to buy and hold forever is Fidelity Total International Index Fund, FTIHX. The fund tracks the MSCI All-Country World Index, excluding the United States. It represents approximately 5,000 international companies. The top companies in this fund are made up of companies like Taiwan Semiconductor, Nestle, and ASML Holdings. It has an expense ratio of 0.06%, which means that if you have $10,000 invested in FTIHX, you're essentially paying $6 for Fidelity to manage this fund for you. The fund started in 2016, and since then, its average annual total returns has been 5.99%. What the Fidelity Total International Index Fund will do for you is provide you exposure to the international market outside the United States, exposure to different countries, sectors, and even currencies. And we can look at what happened to the Japanese stock market as a lesson on why we might want to hold an international fund. At the end of 1989, the Japanese stock market's capitalized value was considered the largest in the world. The Nikkei 225 index, the index of 225 largest publicly owned companies in Japan, reached an all-time high of close to 40,000. Sadly, 22 years later, the Nikkei was under 8,500 and to this day has yet to reach its all-time high again. But sadder is the Japanese investor who failed to invest in international stocks outside of Japan. The US-based companies are currently the world leader in market capitalization and revenue, but who can confidently say that it will stay like that in the future? It would be unfortunate, but the same thing could happen to the US stock investors. I personally still have strong confidence in the US economy and US-based companies as a whole, but I also have to continuously check my assumptions. Financial writer Larry Swedroe had a saying, "Never treat the highly likely as certain and the highly unlikely as impossible." As you get more comfortable with the international market, you can start adding them to your portfolio. And the Fidelity Total International Index Fund is a great option to represent your international holdings. The third Fidelity fund you want to buy and hold forever is Fidelity Zero Total Market Index Fund, FZROX. The fund tracks Fidelity's in-house Fidelity US Total Investable Market Index. It represents approximately 2,700 US-based companies. The top holdings in this fund are Apple, Microsoft, and Amazon. It has an expense ratio of 0%. Yes, you heard me right. $0 to invest in Fidelity Zero Total Market Index Fund. Thus, the zero in its name. The fund started in 2018, and since then, its average annual total returns has been 11.82%. The Fidelity Zero Total Market Index Fund is a total market index fund, which means it tracks the total US stock market. So this will be a great option as your core equities holding in your 3-fund portfolio. However, there are a couple of things I do want to note with this fund, especially in comparison to the 2 other equities options I'll cover here in a bit. One is the fact that the index it is tracking is Fidelity's in-house index, Fidelity US Total Investable Market Index. This necessarily isn't a bad thing, but there are actually more than 2,700 publicly traded companies in the United States than what this fund represents. What this fund has done is exclude really small companies from its index. In the big scheme of things, this doesn't make that much of a difference in performance since the representation is based on market capitalization. So the excluded companies would only represent maybe 1% or even less than that of the total fund. But this is still something to note. The total market here isn't quite the total market. A second item to note with the Fidelity Zero Total Market Index Fund is the fact that you can't transfer your shares to another firm without selling your holdings. And when you sell your holdings, you have to pay taxes on your capital gains. The Fidelity Zero Total Market Index Fund was designed with 0% expense ratio in order to gain more customers. So Fidelity doesn't want you to move your money to a different firm, and this limitation creates that barrier. Paying 0% is nice, but you want to understand that free comes with some strings attached. But if you're planning to stay with Fidelity for life, Fidelity Zero Total Market Index Fund is a great equities fund to hold. The fourth Fidelity fund you want to buy and hold forever is Fidelity Total Market Index Fund, FSKAX. The fund tracks the Dow Jones US Total Stock Market Index. It represents approximately 4,000 US-based companies. The top holdings in the fund are Apple, Microsoft, and Amazon, essentially the same as Fidelity Zero Total Market Index Fund. It has an expense ratio of 0.015%, which means that if you had $10,000 invested in Fidelity Total Market Index Fund, you're essentially paying $1.50 for Fidelity to manage this fund for you. The fund started in 1997, and since then, its average and annual total return has been 8.29%. It's Fidelity's original Total Market Index Fund prior to the introduction of Fidelity Zero Total Market Index Fund. And Fidelity Total Market Index Fund does exactly what its name implies. Invest in the total US stock market. Essentially, every US-based company is out there. When it comes to investing in the stock market, the key principle you want to abide by is diversification. Many people tend to think the only way to make money in the market is to beat the market by either selecting good stocks or good actively managed mutual funds. Unless you're a professional investor with hundreds of analysts working for you around the clock, analysts who are constantly interviewing and researching companies and industries, we can't win in the stock picking or fund picking game. The odds are just stacked too high against the individual investor. So the best strategy to beat Wall Street is to just track the market and at the lowest cost. And Fidelity Total Market Index Fund is a great fund to hold as your core equities holding in your portfolio if you want more flexibility from the Fidelity Zero Total Market Index Fund. The fifth Fidelity fund you want to buy and hold forever is Fidelity 500 Index Fund. The fund tracks the S&P 500 index, which represents the 500 largest publicly traded companies in the United States. At the time of this video, there are exactly 508 publicly traded companies in this fund. The top holdings in this fund are Apple, Microsoft, and Amazon, essentially the same as Fidelity Zero Total Market Index Fund and Fidelity Total Market Index Fund. Not a surprise given the company representation is based on market capitalization, and these big companies represent a good percentage of the market as a whole. It has an expense ratio of 0.015%, same as Fidelity Total Market Index Fund. So if you have $10,000 invested in Fidelity 500 Index Fund, you're essentially paying $1.50 for Fidelity to manage the fund for you. The fund is the oldest of the bunch. It started in 1988, and since then, its average annual total returns has been 10.66%. When most people talk about the stock market, they're most often referring to the Standard & Poor's 500, not the total market index. And the reason is because it's so much older. It was created in 1926 when it began tracking 90 stocks, and in 1957, the list expanded to 500. And for the past century, it has been the go-to index to represent the stock market. When you turn on any financial news, reporters are always discussing how the S&P 500 is up 50 points or down 100 points. It essentially represents the 500 largest US corporations weighed by the value of the market capitalization. And because it's weighted by market cap, though there are approximately 4,000 publicly traded companies in the United States total, these 500 stocks represent about 80 to 85% of the market value of all US stocks. And the weight within the index automatically adjusts based upon the changing stock prices. To this day, the S&P 500 remains the standard to which professional mutual fund managers and investment firms compare their returns against. So if you want your equities holding to match the performance of the largest US stocks, since they're essentially what moves the market, hold Fidelity 500 Index Fund as your core equities holding. But I do want to say this. Whether you choose the Fidelity 500 Index Fund, the Fidelity Total Market Index Fund, or the Fidelity Zero Total Market Index Fund as your core equities holding, you really can't go wrong with any one of them. They're all great funds. You just want to understand exactly what you're buying. That's it, guys. I know I normally advocate for Vanguard funds, but sometimes you may not have the ability to choose the investment firm that you want. because maybe your employer doesn't offer it. That was the case for me, and therefore most of my 401k is actually invested in Fidelity. Fidelity is a great investment firm, and if you're looking to invest with them, pick any of the 5 that I mentioned here, and you can't go wrong. If you'd like to learn more about the 3-fund portfolio and why you might want to consider it as your strategy, check out my video here. Thank you guys for watching. Until next time, all the best.